Weak US jobs data overnight strengthens bets the Fed will cut later this month. Australia's economy grows faster than expected, and there's an export boost for South Korea. That's coming up in our 5 Things in 5 Minutes on Thursday, September the 4th. And then in our deep dive interview, ANZ senior economist Adelaide Timbrell analyses Australia's stronger than expected growth figures for the June quarter.
We're finally seeing, after some rate cuts, some tax cuts, and some solid household disposable income growth and wages growth, that people are starting to spend.
But first, in 5 and 5 with ANZ, US rate cut bets were boosted overnight by weak job openings data. JOLTS job openings fell to 7.18 million in July from 7.36 million in June. ANZ economist Bansi Madhavani says this supports a 25 basis point rate cut by the Fed this month, as Fed officials start to prepare for their decision.
This is the last week when we hear from Fed officials before their communication blackout period, which begins over the weekend. Fed Governor Waller said that a rate cut at the upcoming meeting is warranted. He cited labor market as a reason and noted that it is important to get ahead of an imminent labor market slowdown. In the near term, he is expecting multiple rate cuts in the next few months, maintaining the view that inflation will start moving back to 2% target in the next 6 to 7 months.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.1% and the Nasdaq rose 0.7% on those rate cut bets. The yield on the 10-year US Treasury was down 7 basis points to 4.208%. Gold was up 1.3% at a new record high of $3,638 an ounce. West Texas oil futures were down 2.6% at $63.89 US a barrel. The US dollar index was down 0.2%. That saw the Aussie dollar up 0.45% at 65.44 US cents. It was also boosted by that stronger GDP data in Australia. And the Kiwi was up 0.2% at 58.76 US cents. Number 2, Bunsie says global long bond volatility continued overnight, particularly in the UK. The focus there has been on the UK 30-year gilts, hitting their highest level since 1998, although they were down slightly overnight at 5.59%.
One of the fiscal rules that the UK Chancellor upholds is a current budget rule, which means that government's day-to-day spending is supposed to be met via revenues over the forecast horizon. Now, ahead of the autumn budget, which is scheduled to be held on 26th of November, financial investors are concerned that the government's fiscal headroom has narrowed. So ironically, like a self-fulfilling vicious cycle, what we're seeing right now is there's a sharp rise in gilt yields, which if sustained will raise government borrowing cost, which raises government spending and thereby erodes fiscal headroom, which in itself is driving the surge in yields.
Number 3, Australia's economy grew 0.6% in the June quarter, above expectations because of higher household consumption. Annual growth of 1.8% was the fastest in nearly 2 years. The boost saw traders pull back their November rate cut bets slightly. Here's ANZ senior economist Adelaide Timbrell.
The thing about GDP is it's, of course, a lagged data set. It's telling us what happened between April and June, but it does tell us that there's pretty strong evidence of a private sector recovery and particularly consumer recovery. So if anything, this is going to tell the RBA, oh, look, people are actually going to grow their spending even without the full effect of those 3 rate cuts so far. And that may limit their appetite to ease rates much from here. So we still have the call that the Reserve Bank will just cut rates one more time in November by 25 basis points and then hold steady.
And we'll have more from Adelaide on those GDP figures in today's deep dive interview. Number 4, South Korea's economy grew faster in the second quarter than initially thought, at 0.7% versus the previous estimate of 0.6%. ANZ economist Crystal Tan says that means annual growth of 0.6%.
This revision reflects late arriving June data that wasn't available during the flash estimate, and the stronger performance was driven by robust exports, particularly semiconductors, and also construction and intellectual property investments. Those numbers were stronger than the initial estimates, and they help offset downward revisions to facility investment.
Number 5, Crystal says the revision comes as the Bank of Korea is already expecting a small pickup in growth.
Last week, the Bank of Korea already raised its full-year growth forecast to 0.9% year-on-year, up from 0.8% previously. So the main constraint that's holding back the Bank of Korea from policy easing has been house price stability. So this is the key watch point. If we look at the Bank of Korea's policy messaging last week, also the vote split, they do signal an easing bias. So as long as house prices continue to stabilize in the coming weeks, we do continue to see scope for the Bank of Korea to deliver a 25 basis point cut as soon as next month.
Crystal tan there. Now, in our deep dive interview, ANZ senior economist Adelaide Timbrell explains to my colleague Alex Tarrant what drove Australia's economic growth over the June quarter.
Household consumption was the main driver of the stronger GDP result. We saw it shoot up by 0.9%, its strongest quarterly increase since 2022. So we're finally seeing, after some rate cuts, some tax cuts, and some solid household disposable income growth and wages growth, that people are starting to spend. We also saw the household savings ratio come down by a complete percentage point from 5.2 to 4.2. Now, this offset some weakness in other parts of the economy. Net trade, so exports minus imports, just only added 0.1 percentage points to the quarterly growth figure, while public demand actually added nothing. So we've seen a bit of weakness over the last 6 months from the public sector, offset by strength in private demand.
Yeah, let's just go into the state of the different sectors of the Australian economy. That public demand, was it expected 6 months ago that it would be weak for the last 6 months?
No. So we did think that the Q1 public demand fall would be a bit of a blip, but what we're seeing now is 6 months of sustained falls, particularly on the investment side. So in real terms, public investment activity has fallen quite a bit over the last 6 months, and this adds a little bit of doubt as to how much we'll see public demand grow in the coming quarters. However, look, when we look at it from an annual basis, it's actually still up 3% over the last year, which is more than what GDP has risen in the same time.
And then private investment, what's happening there?
Yes, private investment was also weak. It rose just 0.1% in the quarter. So we saw falls in non-residential building, very little in terms of dwelling construction. I think what we expect to see is an improvement at some point from business investment. Now that consumers are spending more, that should, if it's sustained, give businesses a little bit more appetite to invest and expand. As the overall economy lifts, you get that same kind of risk appetite rise. And when we know rates have come lower and we haven't seen any of the effects of the May and August rate cuts, nor have we seen much of the February effects so far, that will make it easier for businesses to invest as well, partly because it reduces the cost of debt for them, but also because they know it will create a stimulatory effect on their customers.
This jump in household consumption last quarter, I guess that's been on the cards for a while. People have been looking for it to come through off the back of the previous budget and rate cuts. Is it sustainable?
So I don't think we're going to see a 0.9% increase in household consumption every quarter from here, but we do expect to see much better results than we have in recent times. So there are a lot of things supporting household consumption that haven't really flowed through to the data until this quarter. We're paying less taxes than we were a year ago. We're going to be paying less interest, those people who are indebted over the next year versus the last year. Inflation is back where it should be. The labour market remains tight. So most people who want a job have a job, and wage growth is unlikely to decelerate much from here either. So most people who want a job have a job, got a pay rise, not paying as much on the mortgage if they have one, and are not seeing their groceries go up so much that their real consumption, because this 0.9% is not the dollars you spend, it's the amount of things you buy, real consumption has more support to rise.
Adelaide Timbrell there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Thursday, September the 4th. Catch you tomorrow with a look at how Australia's imports and exports went in July. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.